Welcome, everyone. We're so glad that you're here, that you're able to make it, and it's particularly gratifying for us to see so many of our clients in the room for both Guy and me. So thank you again for making the time to come. We do have a very full presentation, so I'm going to keep the introduction pretty short. My name is Masha Yevzelman. I'm a shareholder here at Fredrikson and Byron. I'm also chair of our tax controversy group. And I'm proud to say that we do have the largest tax controversy group in the region. We work on many types of tax controversies, both federal and state and local, and we take them all the way from audits through appellate litigation. And I'm honored to have with me Guy from WTP Advisors, and he's a principal there. Guy has more than 20 years in transfer pricing, valuation, and business process improvement consulting experience. And WTP, as Guy will tell you more about, is a tax and business advisory services team specializing in international tax, transfer pricing, and international valuation. They work on planning, compliance, and controversy support. So before I turn it over to Guy to go through our agenda and kind of where we're going to go today, I want to talk about a couple housekeeping things. We did get CLE credit, so you have the white sheets of paper at your spots that tell you how to get CLE credit. The green sheets of paper under your packets are evaluations, and we'd very much appreciate if you could fill those out. And then also, as I'm sure you know, we do have a happy hour after the presentation, so hopefully you can stay and we can chat then.
Great. Thanks, Masha. So here's what we're going to talk about today. Obviously, an introduction and go through what is transfer pricing. That might be a little basic for some of you that are already doing some transfer pricing, but I just want to get everybody caught up and on the same page. Then we're going to go into talking about controversy in the context of transfer pricing, intercompany agreements, and then go through some case studies. I want to make sure we leave enough time to go through these interesting case studies. One case study involves the IRS, and then the second one involves the Canadian Revenue Authority. And then at the end, we'll redo a recap and talk about kind of key takeaways and leading practices. Before we jump into the content here, how many people have dealt with transfer pricing in some way or are familiar with transfer pricing? Good, that's most of the room. So, okay, with that, let me jump in. I'll go through the basic stuff pretty quickly then, since most of you are somewhat familiar with it. So just to kind of set things up, here's a graphic of what we're seeing in the transfer pricing enforcement environment. So transfer pricing, we actually were talking with somebody earlier today, a lot of people see transfer pricing as a planning tool, and it is a planning tool for a lot of multinationals to look at trying to manage their effective tax rates. But it's not only is it a planning tool, though, it's also a risk issue. Tax authorities are looking at transfer pricing, and they can, in some cases, be very skeptical of what's going on there. They see, technically, multinationals are supposed to be conducting their transfer pricing at arm's length, and they see some bias in terms of the approaches. And so when they go in, they're looking at transfer pricing documentation, which explains how companies are administering their transfer pricing, and they're going to scrutinize that and see to what extent the transactions may or may not be at arm's length, and then coming in and with very much aggressive approaches in terms of looking at opportunities to create income in their tax jurisdiction. So we're seeing very intense positions. So once a tax authority has a position in place, it's very hard to get them off it. So we're seeing more and more of that.
So we have here an update on some of the sample high-profile cases, and you can look at them in your materials. I'm not going to go through each case, but it lists the ones that either are currently active in appeals or at tax court, or a couple at the circuit court for appellate litigation. So they're really at various stages, but you can see the dollars of the transfer pricing adjustments there. I mean, ranging from multi-million-dollar adjustments to multi-billion-dollar adjustments, like the Microsoft 30 billion one. So they're obviously huge, but the issues present in these transfer pricing disputes are really applicable to anybody. So for example, the recent 3M dispute, we have a Brazilian subsidiary that paid royalties to the US parent for the licensing of intellectual property and use of technical services. And they paid $5.1 million in the 1 year for those services and the licensing. And the reason for that is because Brazil has an approved rate of 1%. And the IRS instead used a global rate of 6% to say that the transfer price should have been $37 million. And so that could really happen to any company. Here it happens to be 3M. Thomson Reuters also has an interesting fact scenario. It's a more recent case. So they have 14 U.S. subsidiaries of Thomson Reuters that were charging the Swiss affiliate for various services, software development, data listing, content creation. And the IRS increased the prices paid for those services significantly, such that Thomson Reuters is now being threatened with $190 million in back taxes. So this slide sort of sets the stage for what we're going to talk about. This is the typical IRS transfer pricing IDR. That's the first thing that's received by a taxpayer when an audit is initiated. So a few key components of this IDR. First, it requests a response within 30 days. Second, it requests principal documentation. So we're going to talk about what that is. Third, it talks about the requirement that that documentation should be contemporaneous or in existence when the return was filed. And fourth, it says, or else there's a penalty, in essence, right? So those are sort of the four elements of this IDR. So we'll talk about in our presentation, what is this really requesting? How does it fit into the entire controversy process once an audit commences? And then what happens if you can't answer this IDR? What if you don't have that contemporaneous documentation? So with that, I'll turn it to Guy to set the stage on what is transfer pricing.
So what is transfer pricing? Did I go over a slide?
Fine.
There we go. All right, so let me start with what's relevant for transfer pricing. Transfer pricing, by definition, is looking at controlled transactions. So when you think about what a controlled transaction is, a traditional view of that might be you have a multinational, there are entities across borders, and entities interact with each other. They either sell products to each other, or provide services, or develop intangibles or technologies that are developed by one and used by another. So that's a traditional controlled transactions between affiliates of a multinational. But this definition of controlled transactions in Section 482, which are the regulations that dictate transfer pricing in the U.S., is very broad. It's any kind of control. So if you can show that entities are acting in concert with one another, it doesn't matter what the ownership is on top. It could be a JV, it could be independent parties, but if there's a motivation to reduce taxes, if the IRS or another tax authority can show that, then they're potentially at risk of transfer pricing disputes. The last part is a presumption of control arises if income or deductions have been arbitrarily shifted from one entity to another in a way that reduces their taxes. So here's an overview of transfer pricing. So it's a price paid in controlled transactions between parties is the definition of transfer pricing. And there are four main types of transactions that we look at. The sale of goods is the basic one. That's the most straightforward one. So you have a sale of bicycles from the U.S. entity to a French entity. Those are straightforward, and you can see the value in terms of this tangible good. So those are the lowest risk transactions, frankly, usually, because there's actually a good going across borders. The rest of these are less straightforward. And the second one is intangible property. So what we mean by intangible property is something that is not there. Doesn't have a physical form, and something that has value, and is licensed a lot of times from one entity to another. So that can be squishy because what is the intangible? We'll talk a little bit more in detail later on, but what are the intangibles? What's the value of the intangibles? Does it really generate value? And what should be the price paid for those? Then we have intercompany services. So if you have a central service provider entity or even a group in the U.S. that's providing IT services to another country like Canada, the Canadian entity should be paying for those services. And the IRS just released several 100-plus page regulation just on services. And then you have intercompany financing. So that involves loans or guarantee fees. So anything to do with cross-border intercompany financing is applicable as well across entities. So most countries, not all, some countries look at different requirements, but most countries look at the arm's length standard as the way to test whether or not the transfer pricing is appropriate in their countries. I say not all because sometimes countries like Brazil and other countries will develop formulaic approaches that might deviate from the arm's length standard, but in general, the arm's length standard is the standard that most tax authorities look at. And the primary concern is whether or not income was underreported. So is the country receiving its fair share of taxable income in the jurisdiction? So this is the arm's length principle / standard. What I'm trying to do is mesh some of the language that's in the various authorities that are out there. The US refers to the arm's length standard. In other countries, they might talk about the arm's length principle. In essence, they're the same concept. And that means when it's the price paid between related parties, if you can show that this unrelated parties would enter into a similar transaction under similar circumstances, then you've met the arm's length standard. And I put the definition of the arm's length principle and the arm's length standard in there in the OECD guidelines and section 42. The OECD guidelines are created by the OECD to help create a framework for countries that are members of the OECD to follow. So they're guidelines that we refer to a lot, and a lot of countries refer to the OECD guidelines as their authority. So I just put this slide up here just to kind of give a comparison real quick in terms of how transfer pricing relates to valuation, because I refer to these two fields as kind of cousin fields because they grew up separately within professional realms, but they really get at the same thing. In transfer pricing, I already talked about the arm's length standard as being our standard. In valuation, whether we're valuing a business entity, a business overall, a part of a business, or even an intangible, there are three different standards that are main standards that are looked at: the fair market value standard, the fair value standard, and the investment value standard. And those standards are meant to suit the purpose of the valuation. In transfer pricing, we can have situations that involve purposes that revolve around all the standards of valuation, like M&A, like a minority shareholder area. So we have all these different situations where valuation has developed different standards for valuation, but we just captured in the arm's length standard. So you can kind of see there that there's a lot of potential for some conflict in those interpretations. These are the regulations. I'm going to relieve you of not going through these in detail, but just to give you a feel for how formal the U.S. regulations are, there are 9 different sections within 482 where the IRS and the Treasury have really tried to flesh out very specific rules. And the challenge here is the more rules you put in place, by definition, the rules might not suit different situations, so you're creating conflict with the arm's length standard. And in many different areas within the regulations, you can kind of look at what the regulations are saying. Like one controversial area was whether or not companies need to include stock compensation expense when they're charging out services. And it's been shown in the courts and in economists that normal parties would not include those in service charges, but the IRS insists on keeping it in the regulations. And so now it goes to court, and there's still some debate as to whether or not it's in there. The majority of the field says, no, it's not arm's length, and it's not the way it's done, but there's still a lot of controversy around that. So did I skip over another slide? Okay.
I'm going to put me in charge of the clicker. I'm just kidding.
Go ahead, yeah, please. So why is it important? I talked about this a lot already, so I'll just go real quickly. Tax planning. So a lot of multinationals are using this as a tax planning tool. And it's a key way for many companies to achieve a low effective tax rate. So when you're looking at 10Ks and you see some companies have a 10% or a 15% effective tax rate and they're based in the US, well, they're doing a lot of tax planning, and transfer pricing is probably going to be a lot of that. But along with that, there's tax risk management. So if a company is doing tax planning, they're going to want to do risk management. But even if a company's not doing tax planning, the tax authorities are looking at all companies and saying, you're doing tax planning. So by definition, you're going to be thrown in the pot, and you're going to be at risk of some controversy, even if you're not doing tax planning. And then beyond tax, various companies might have non-tax issues associated with transfer pricing if you've got transactions across business units of a multinational or even a non-multinational within domestic transactions. That can create a lot of conflict. I see it in a lot of companies where they're arguing over internal pricing on services or product going from one BU to another. And I counsel a lot of companies that's waste. Whenever there's time spent trying to divvy up profits internally, it's a waste of time for all the executives and all the teams involved, and we just need to get rid of it and put in some kind of mechanism in there to try to normalize it. Do you want to do the clicker? So one area I wanted to highlight is intangibles. So as you can imagine, we talked a little bit about it already in terms of what the intangibles are and how hard it is to get your arms around it. There's so many different dimensions of where intangibles can be controversial. First of all, what is the intangible? Some companies don't know what they are. You know, they're very entrepreneurial. They've created a lot of value, but they haven't really thought through from a tax perspective or from any perspective. You know, what is it that makes them great? What is is it technology? Is it their brand? Is it their know-how? So, and then there's a lot of uncertainty around what the definition of an intangible is. And then who owns it? So from a transfer pricing perspective, that can get tricky because when we think of ownership, are we talking about legal ownership? Or are we talking about economic ownership? And ideally, they're two in the same, but a lot of times there's some deviation. And from a pure economics perspective, when we look at ownership of an intangible, we think of the entity that pays for the R&D or that pays for the advertising, that entity would own the technology that arises from the R&D effort. That entity would own the value associated with the branding that comes out of the advertising. So companies need to be very careful about, you know, what are their intangibles, and then making sure that whichever entity they want to own the intangibles legally or economically is paying for those intangibles. And of course, what the value of it is a huge issue. And so the unique valuation methods that are used, there's a lot of assumptions in those methods, lots of analytics that goes around, lots of research in terms of figuring out what the value of it is, and then which rules apply. Masha did a great job summarizing. Brazil is a good example of imposing their rules on, you know, who owns an intangible. And in fact, sometimes they actually force companies to move their intangibles into their own countries just because they make it a law that says after so much period of charging royalties, now that entity owns it. So that's something that's another Brazilian feature. So in terms of the global transfer pricing landscape, well, the trends that we're seeing is that most concerns about multinationals moving profits arbitrarily. There's more entrenchment in positions, like I mentioned before, and there's more litigation as a result. So we're seeing that across the board. We're seeing it with large companies, as we said before. We're also seeing it with smaller companies. $70 million company is an example of a company that I worked with that had a transfer pricing dispute of $4 million. OECD, there's a BEPS initiative out there. It stands for Base Erosion Profit Shifting. And that's a huge initiative that the OECD is sponsoring based on a request from the G20 countries, where they're looking at trying to increase transparency in the tax system and creating common rules. And of course, some of the areas are intangibles, and then what they call country-by-country reporting. There's a framework that the OECD has come up with that lays out the economic indicators of a global multinational, and then they have to report what those indicators say. So indicators like revenue, profit, headcount, assets. So you have to lay all that out by entity, by country, and then report it to the tax authorities. And then they share this information, and then the issue there is that tax authorities are going to do their own analysis behind the scenes to determine whether or not they think your transfer pricing is legit or whether they can attack it. Even the U.S. states are certain U.S. states, I should say, are very active in transfer pricing. Those that look at, we call them separate return states, or they're known as separate return states. So they look at transfer pricing as an area of risk where they're receiving below what they should be receiving. So there are certain states that are very active. And then there's a software out there called Chainbridge which has created a lot of controversy. That's a black box software that's been used by various state governments and even the IRS to crank through numbers and come up with adjustments. So that hasn't been doing very well in the courts, but it's still, companies still have to spend a lot of time refuting them and a lot of legal expenses and things like that. So that's the landscape. And then this is just a graphic of the BEPS project just to show how comprehensive it is. There are 15 different aspects to it. And there's, transfer pricing is prominent in here when we look at intangibles, when we look at high-risk transactions and disclosure requirements. So if you look at these, you have coherence, substance, and transparency are the three main pillars of the BEPS initiative, going across the digital economy and financial instruments.
All right, so this next portion of the presentation, we're going to go through the life cycle of a transfer pricing controversy. So again, the areas of concern that we're looking at, and Guy talked about this a little bit, is intercompany services, IP migration and cost sharing, guaranteed fees, supply chain restructuring, and permanent establishments. So keeping these in mind as we go through how this all works. So the first question that often comes up is, how is a taxpayer selected for a transfer pricing audit? So in the Internal Revenue Manual, it's set out that certain individual and corporate returns are screened manually and certain returns are screened automatically. So if it's assets of less than $10 million, then that's an automatic mathematical technique called the discriminant index function that determines whether a return is going to be selected for an audit. But for corporate returns where the assets are greater than $10 million and those with international issues, there's a manual screening process. And so then someone looks at it and decides whether or not to audit the taxpayer for a transfer pricing audit. It'll look at what's reflected on the return for that or for the entire entity. So the examiners then, they are directed to look at returns specifically that show any sort of foreign business transactions or those that have interest in foreign financial accounts. So all of that needs to be disclosed. There's various reports that get attached to the return, like Form 5471 is an example, 5472. They'll reflect this information, and so that's what they're looking for. And if the IRS sees significant cross-border related party transactions, that's going to attract an audit, especially if you have entities in low-tax jurisdictions. So in February of 2014, so now more than, 3 years ago, the IRS released this transfer pricing audit roadmap, and it gives a 24-month timeline for auditors to follow loosely as best they can to get through a transfer pricing audit. And it has these 9 steps that they're supposed to go through. And so I put the URL there on the bottom of the slide, so if you really want some good reading, you can read through what the IRS tells its auditors to do. So it's got all sorts of techniques, citations, and it is important to read through if you are going to go through an audit or if you're doing an internal audit, because it'll tell you the process that the IRS will follow. The 24-month timeline, they try to adhere to that. Obviously, a lot of audits take longer than that. So we're going to go through some of these steps here in a little bit more detail. So we talked about the kind of analysis that they do to select a return. They're just looking what are there transactions or not with related parties that are cross-border. Now, once they've selected a return, they're going to look at those tax returns a lot closer. So they'll look at those 5471s, 5472s. Then they're going to compute the key financial ratios like rates of return, income to cost. They're going to do those for multiple years. They might do that at an entity level or product line level. Then they're going to compare those to industry ratios, and they're going to look at that to see, are the profits reasonable or unreasonable? Are they within industry norms or outside of industry norms? And this all happens before they even contact the taxpayer. They're going to try to learn and understand the business of the company that they're auditing. And to do that, they'll pull all the publicly available information, or they should, like the 10Ks, any trademarks that have been filed, any patents. So they're going to pull up everything they can. Once they think, okay, yep, we're going to proceed on an audit, then they go to the next phase.
And that's an important point. A lot of times companies aren't really paying attention to what's out in the public domain. And I actually spoke with an IRS economist once, and yeah, it's really easy to find an adjustment. I just Google it, and there it is. That's what she basically said. So you definitely want to Google your company or whatever your client as you're looking through this process.
Yeah, that happens in all sorts of tax controversy contexts, I will say, not just transfer pricing, like especially more junior agents, like that's the first thing they'll do is Google and see what they can find. And so whatever's publicly out there is really, really important and needs to be very careful. So once they decide to proceed with an audit, that's when they contact the taxpayer. And along with that contact, they get that initial information document request, or IDR, that I kind of started the presentation with. And so this is a mandatory IDR that they have to issue in a transfer pricing audit. It comes up right away. And so what it requests is principal documents. And so I listed out what those are. Typically, these are in the form of a study. So like something that Guy would have prepared. Not all taxpayers have that. So there's the list of what these are that they're supposed to look for. They also ask for an index of background documents. And so those are the documents that will be underlying the transactions. They don't want the background documents right up front. So the request, though, it says, okay, we want these documents regardless of the form, but what's really critical is that these documents need to have been contemporaneous or in existence when the return was filed. If they're not, it's not responsive to this IDR. So in the examiners, I mentioned, and I highlight in red there, the statutory 30-day response time. That is in the statute. So with a regular tax controversy, you can get extension after extension after extension. This is a statutory 30-day deadline, and they're instructed to strictly enforce that 30-day response time. Some might give an extension if it's a really big deal and they get permission to do so, but that still puts the taxpayer at risk. So if taxpayers don't have or are not able to provide this transfer pricing documentation, the examiners will then issue IDRs to elicit all of that relevant information in a different form. And under the statute, it indicates that penalties will be assessed if certain thresholds are met. And we'll talk about the penalties in greater detail later. So with the penalties, there are reasonable cause exceptions, and there's two types of penalties, and we'll talk about the exception. But what's important to note up front is that for one of the types of penalties, if this documentation was not provided within 30 days or it didn't exist, you cannot meet the reasonable cause standard. That's one of the requirements. So after that IDR is answered, or maybe contemporaneously, the agent will issue other information document requests and use other tools to conduct their examination. So they're going to ask for financial statement information, accounting records, corporate minutes, training materials, any sort of policies on transfer pricing, information about the entities. And so I've put here a few tips on what to do with these, kind of right up front here. So the first thing that I would really emphasize is know exactly what you're providing in response. There should be one central or key person, either internal with the organization or external, who knows everything that's going to the IRS, everything that's being said in IDR responses, so that one person has knowledge of the entire picture. I mean, a transfer pricing audit, just to back up, requires a team. So it's not just a one-man show. So you have to have an economist involved who's working on this issue. You have to have either in-house counsel or outside counsel working on the issue. The accountants are involved. And so if information is coming from several different sources, that becomes a problem, because then inconsistent information might be provided. Know how the information that you're providing is going to influence the outcome. So really think it through. Why is this information relevant? Does it raise any other issues when you're providing it, especially if you're writing out answers? There are ways to carefully answer an IDR without giving away other issues that the IRS may not have thought of yet. Think about whether the information was actually requested. Answer the IDR without providing too much information. Another item that comes up very often is that information in another language? So it's really easy to get information from your foreign subsidiary, and it's in a totally different language. So a recent audit that I had, it was in Russian. So we had a U.S. entity with a Russian related entity. There were sales going back and forth, and the financial information came in English from the American entity, but was in Russian from the foreign entity. And before we got involved, nobody on the team, other than the client, spoke Russian, except for the IRS agents. They were both Russian, so they knew exactly what they were getting. So once we became involved and I started looking at the information, it was quite easy to spot the inconsistencies in the US information and the Russian information. And it looks just like financial data. So you might be like, oh, this is just a spreadsheet. But it's really important to know why everything's being provided and what it actually means. If there's deadlines that are difficult to meet, always keep open communications with the agent. So that's the way to avoid sort of more severe tools. They'll hem and haw and they'll say, oh, I can't give you an extension. I got to talk to my manager. And it's like, just push that. They'll give you an extension usually. It's not going to be a big deal. They'll also ask for meetings with and interviews with the taxpayer. So again, looking at your team of who's involved in this audit, the one key person must be at the interview because they need to know what's being said. That person should be preparing the person being interviewed so that the interviewee knows what's already been provided to the IRS, what has been written in IDR responses, because they need to not inadvertently say something that would totally change the course of this audit. So it's really important to be careful with these. Another tool that's sort of obvious that's available to the IRS during examination is their involvement by the attorneys, so by the Office of Chief Counsel and an IRS economist. So as the IRS starts getting this information back, they have an economist working on the case who's going to be eventually doing the economic analysis that's going to be incorporated in the report. But that just happens behind the scenes typically. So then there's more severe tools that are available to the IRS if the IDRs aren't getting them what they need or if they're not getting what they want from the interviews. The first is a formal document request, or an FDR. So this request is used to get information that's in control of a foreign subsidiary or another foreign member of the taxpayer's group. And the reason it's formal or called something different than an IDR is because it carries a consequence if you don't respond. So failure to respond within 90 days limits your ability to then later use this information in litigation. And if a taxpayer receives an FDR, they can move to quash it in U.S. District Court. Summonses have been very commonly and publicly used in transfer pricing audits. And so there's public disputes on this issue, both with Facebook and Microsoft. So these are issued if an IDR is not responded to after several requests. So they have to go through this whole process before they can even get to a summons. So they'll keep reissuing, asking for it again, threaten the summons again. They have to get approval from counsel to issue the summons. And then in order to enforce it, they have to get the Department of Justice involved. So to enforce a summons, they need to go to U.S. District Court. The Department of Justice will then represent the IRS in that dispute. And so that's where Facebook and Microsoft are now. They both have summons enforcement actions pending in District Court. In Facebook, I know the IRS is seeking to enforce 7 summonses, and they're doing that actually at the same time that Facebook has a tax litigation case pending before the U.S. Tax Court. So one of the answers that Facebook has in the summons suits is like, look, you have discovery in U.S. Tax Court, and you're just trying to use this process to bypass discovery. So that's what their dispute is sort of centered around. In Microsoft, certain documents weren't produced under claims of privilege. And so we had the accountant privilege in play here with some of the documents, the attorney-client privilege, and also the work product doctrine. And so Microsoft said, we're not producing these, so now they're trying to get those through summons enforcement through district court. Well, usually it does take a lot to get to summons enforcement. One case that we were brought in on late already had a summons in place. And so a summons had already been issued, and the reason was because no one was communicating with the IRS and why the IDRs weren't being responded to. Taxpayer did not have contemporaneous documentation. Taxpayer had records all over the place, and they just literally couldn't get their act together. But because they weren't communicating with the service, they were in a summons situation, but it never went to enforcement. Because by the time you actually get to U.S. District Court enforcement, you're usually able to respond.
This highlights reputational risks as well when things get public like this. And transfer pricing as well, not tax in general, but transfer pricing. Lots of issues can come up with from a PR perspective. And Starbucks, for example, had an issue in the UK where there was a lot of public disclosure about the perception that Starbucks was underpaying tax in the UK, and that led to a bunch of PR issues, lots of protests and things like that, and then reduced business. So there can be reputational business impacts as well from all of this.
So, I list other tools that the IRS uses, like third-party requests. They'll typically ask the taxpayer first. Only if you don't or can't respond will they then issue third-party summonses. In some instances, the taxpayer finds out about the third-party summons. In some instances, they do not. And then there's tax treaty exchange of information provisions. And so they can request documents from a treaty country, but that's usually a difficult process for them to go through, and they really only use it if they can't get the information through other means. So once they've gathered all the information, the IRS will do their analysis. They'll figure out, what's the functional risk analysis, and that's done by the economist. The economist will figure out the best method for determining prices. So if you remember that slide that Guy had up with all the Treasury regulations, some of them had certain methods listed for transfer pricing. So they'll figure out which method is the best method, and then the economist will draft his or her report, and then that report gets incorporated into the notice of proposed adjustments. So one thing that comes up often is these penalties. So this kind of gives an overview of what the potentially applicable penalties are that are specifically related to transfer pricing adjustments. The regular penalties are also potentially applicable. So it's not as if they're off the table. We're still, if there's negligence or intentional disregard, there's still a 20% penalty. If there's fraud, there's still a potential for a 75% penalty. But we'll just focus on these specific penalties. Yes. I don't know.
They might, yeah. In fact, one of the partners I used to work with said nothing motivates a tax inspector like a free foreign trip. So they will if there's enough money on the table.
Well, I know they have agents in other countries too, so they don't even sometimes get a trip. You just get someone over there to go over and check it out. Yep, so generally with transfer pricing, we're talking about either a substantial valuation misstatement penalty, which is a 20% penalty, or a gross valuation misstatement penalty, which is the 40% penalty. And there's really two different specific penalties applicable to transfer pricing. There's the transactional penalty. So that one relates to transactions between parties. So that's the reported transfer price. And there's the net adjustment penalty, and that looks to the gross receipts adjustment. So how high was it, and does that get you to a 20% or a 40% penalty? Reducing the risk of a penalty is obviously establish the arm's length nature of the intercompany pricing, and then create and maintain contemporaneous documentation. Skip one? I did. Okay, see, now I have the same problem you did. Right. So this slide lists the penalty threshold. So for the transactional penalty, the 20% applies if the transfer price is determined to be 200% or more, or 50% or less of the reported transfer price. And then 40% applies if it's 400% or more, or 25% or less of the adjusted transfer price. The net adjustment penalty, the one that looks at the gross receipts adjustment, applies at the 20% level if the adjustment is the lesser of 5 million or 10% of gross receipts, and the 40% applies if it's 20 million, 20%. So just a net adjustment penalty example that's fairly simple to walk through. So we have a U.S. manufacturer sells 50 million widgets to its European subsidiary at $5 each, so gross sales are 250 million. The IRS determines widgets should have been priced at $5.30. So the transfer pricing adjustment is 15 million because it's greater than 5 million but less than 20 million, the 20% penalty applies. But you can see how just even a small adjustment in that transfer price, if you're selling enough stuff, gets you to the penalty levels pretty quickly. So There's slightly different reasonable cause standards for the transactional penalty versus for the net adjustment penalty. For the transactional penalty, if that's the only penalty that applies, if that's how the math works out, then you can use your general reasonable cause standards that would apply to any other IRS adjustment. You could also use the heightened standards that I'll talk about that apply to the net adjustment penalty, and that would also work. But you're entitled to use the standard reasonable cause procedures. But if the penalty is triggered in part by a transactional penalty and in part by a net adjustment penalty, then you have to use the heightened standards of the net adjustment penalty to establish reasonable cause. So this flow chart sort of just walks you through of when the transactional penalty applies. So if you have reasonable cause and you acted in good faith, the penalty does not apply. If the price adjustment is less than 200% or greater than 50% of the correct price, then it doesn't apply. If it is at that level, but between, so if it's between 200 and 400, in essence, 20% applies. If it's over 400, then the 40% applies. So the reasonable cause standard for the net adjustment penalty, the one that's sort of quicker to meet, I feel like, is a little different. So here it varies depending on whether you're using a specified method or you used a specified method, one of the ones listed in the regs, or an unspecified method, which would be some other method. So if a specified method was used, then reasonable cause is established if you can show that that method was applied in a reasonable manner, so that it was the most reliable measure and that other methods were ruled out. For an unspecified method, the taxpayer has to demonstrate that the specified methods were considered and then ruled out, and that this other method that was used is really the best method. And then, in either case, that's when that contemporaneous documentation requirement comes in that I mentioned up front. So to establish reasonable cause for a net adjustment penalty, you must have maintained the contemporaneous documentation to establish your transfer price. And that documentation must be provided within the 30-day framework. So we talked about a potential extension if that happens. So that might come from the IRS's ability to exercise discretion for a minor or inadvertent failure not to provide the documentation. But again, the agent's instructions are upfront to impose the penalty and strictly enforce that 30-day deadline. So it is a statutory requirement. So there is a hurdle there for sure. So then this flow chart walks you through the net adjustment penalty, and if there's contemporaneous documentation in place and that reasonable cause standard is satisfied, then there's no penalty. Otherwise, we kind of go through the same flow chart as we did for the other penalty. So now we get to what happens after you receive the notice of proposed adjustments. These are the appeal options and the pre-appeal options. I mean, obviously, first is if you can resolve anything with the examiner and the team, do it then. That's the cheapest and fastest way to do it. Critically, if there's any set-offs that can be raised, they must be raised within 30 days of receiving the notice of proposed adjustment. So a set-off would be if you had another related party transaction that could adjust the other way, essentially. So that must be raised right away. So the key there is make sure that you know about those in advance. So as the examination is happening, think about potential set-offs that you can raise. So because 30 days is a very short window of time to come up with these set-offs. You should, by the time you get the notice of proposed adjustments, you should know what they are, and your team should be able to figure that out. There's the early appeals referral that's available, mediation's available. You can go to appeals if you have a 30-day letter, or you can go to U.S. Tax Court with a 90-day letter. You can also request competent authority assistance if the transactions involve a treaty country. So the most important thing here is if you're going to settle with the Internal Revenue Service on the transfer pricing adjustment, the competent authority then, all they can do is seek a correlative adjustment from the treaty country. So there's not much else that they can do with regard to the transfer price. So it would limit their authority. The other thing to keep in mind is consider the other country's statute of limitations. So a transfer pricing audit, they have this 2-year time frame. It could take longer. They're going to be asking for statute of limitations extensions. And most taxpayers sign those during the course of an audit. But a lot of people forget that you might have statute of limitations in other countries. So if you're going to be seeking an adjustment from the other country, you need to always keep in mind, if I'm extending the US statute, but I'm not extending or doing anything about the other country, I may lose the ability to adjust the other country's consequences. Finally, you could negotiate at any time, so even during an audit, with the IRS for an advanced pricing agreement. So that's available. What that does is it allows a taxpayer to essentially negotiate the transfer price with the IRS, and then they can apply that even to the years that are under audit. So they can then apply it backward, essentially. So it's supposedly sold as sort of a more cooperative process. The problem is what we've seen in litigation is that the IRS has been canceling the advanced pricing agreements and doing the audits anyway. So there's 2 cases currently in process where that's happened. So Eaton is one where they canceled the APA because they alleged that Eaton didn't provide certain information in negotiating it. And Eaton brought a motion before the U.S. tax court arguing like, look, the IRS has to establish that we breached this contract. They have to meet, sort of the usual standards for breach of contract. And the IRS said, no, we don't. This is an administrative determination. And the U.S. tax court judge agreed and said, no, you don't have, it's not a contract. It's an administrative determination. We can evaluate it under abuse of discretion. The IRS has the discretion to cancel it at any time. That was in 2013, and how many of you have heard of Judge Kropa? So she's been indicted on federal tax fraud charges.
Ironic. Very ironic.
And so after, that was the judge who ruled in favor of the IRS. So after that happened, the taxpayer brought a motion to reconsider Judge Kropa's decision. So in the motion, the taxpayer doesn't cite the indictment, but everyone sort of knows that that's kind of what they're thinking, is that, okay, look, this judge is not qualified to reach this decision, essentially. But they essentially, in their motion before Judge Kerrigan, they just re-argued it. So they said, look, no, she was wrong. This is a contract. Please reconsider. And she did grant their motion to reconsider. So now it's going to be reconsidered. But so that was sort of a huge hurdle to overcome, is to even get them to reopen a 3-year-old decision by a judge. So that's where Eaton is. Yes.
Yeah, right.
Yep.
Because they're completed IRS as to whether or not they want to correct.
Yeah. And the APA process itself is often painful and expensive.
Right,
So
exactly.
Yeah, so to go through it just to have them yank it under, a very low standard of abuse of discretion is exactly. So Coca-Cola is the other one that had an APA in place, and they have a $9.4 billion adjustment now following the IRS's just sort of canceling of the APA. All right, so there's the option of going to appeals and filing a protest versus going to U.S. tax court. So it's very case specific on which way you go. I mean, obviously the statute of limitations still has to be open to go to appeals, but assuming that it is, you have to think about, is there an ability to settle in appeals? Is that something that we want, or do we want to just save the resources and go right to U.S. tax court? I think the most important things to consider, if exam wasn't fully complete, if there are errors, if there were things that weren't requested that should have been, and appeals figures that out, they'll send it back to exam. If that happens in U.S. tax court, their new position now is whatever documents weren't provided on exam or in appeals cannot be used in litigation. That's what they're asserting, which is ridiculous. Obviously, U.S. tax court proceedings are public, so I think that's a huge consideration on the PR issue, like Guy mentioned. If you're going to appeals, that's private. That doesn't have to make the news as long as you don't have a summons enforcement action. But once you go to U.S. tax court, it's going to hit the news. There's also the ability to do simultaneous appeals with competent authority requests. And so this slide sort of talks about when you can do that, who has jurisdiction, but in the interest of time, I'm going to turn it to Guy to kind of sum this up.
sure. And taking a step back here, why is this important? Well, first of all, it's paying taxes is terrible as it is, right? Imagine paying taxes on the same income more than once. So we're talking about one-sided adjustments that result in double taxation. And yeah, there's competent authority it could be available, but it's not guaranteed. I mean, the other jurisdictions' books might be closed and out of the realm of being applicable for a competent authority, or the competent authority process itself costs a lot of money, and a lot of companies just put up with double taxation. So, and the other thing we see here is, besides just the controversy area, we see companies that have losses in some jurisdictions and profits in others just because they're misadministering their system. You can have very high effective tax rates as a result of that. And plus you're at risk because the jurisdiction that's loss-making, let's say it's the French tax authority is looking at it and there's losses forever here. They could say, well, we're not getting enough income. So in fact, you can almost have triple taxation there if you're getting an assessment there. So it can be pretty out of control. Then we talked about non-deductible penalties and interest. The key word there is non-deductible. So again, more costs on the company. Unintended transfer of intangibles. So when I served when I was with EY, I was in Belgium for 3 years, and I had a client that was charging out a royalty to the Belgian affiliate, and they were also charging R&D services costs. Well, when they charge out R&D to that affiliate is paying for the R&D, so now it owns it, and now also paying a royalty on it. So those are the kind of things that you need to look out for. You're transferring the IP, and now you're creating a mess from a transfer pricing perspective. Recharacterization of debt or equity, so on intercompany financing is a huge issue. So if a company wants something to be debt, make sure that things are in place where the characterization of debt is respected. Or if it wants to be a contribution of equity, then also make sure it's respected. And put the infrastructure in place, put the legal documents in place, as well as the economics in place to make sure that you're following the substance as well as the form. And then I mentioned before, mix of losses and profits, creating I've seen companies with 90% effective tax rates. So these are the things to watch out for. So taking another step back and looking at what can we do about this. So I'm grateful to be working with Masha here because all that procedural stuff, I can rely heavily on her and her team for that stuff. And on our side, we look at the economics of the transactions, looking at my favorite projects are looking forward, looking at the company as it's growing, and what can we put in place to shore up your transfer pricing so that it makes sense. So it's lowering your risks as well as, if you want to do tax planning, enabling tax planning around your transfer pricing. Audit and controversy assistance is also can be fun for us though, not so much for the clients. But those are puzzles as well, and we'll talk a little bit more. I have some case studies on that we'll run through. Documentation as well. So as planning is looking forward, documentation is looking back. So if a company feels like it's at risk in the past, we'll prepare documentation to hopefully show that their transactions in the past are arm's length. Sometimes it's hard to do, and sometimes it's actually impossible. But we'll do our best to try to explain it. Sometimes we're looking at things, and there should have been royalties that were charged and there weren't, but then another entity was providing services. So we'll look at set-offs as a way to explain it in the past, but it gets pretty clunky a lot of times if companies aren't really thinking through it. And then benchmarking and valuation is all part of that.
So intercompany agreements is another way to mitigate some of the risk here. So intercompany agreements aren't required, but the IRS has the right to impute them if they don't exist. And so they're really important in evaluating the facts and circumstances underlying the taxpayer's transactions. Really good agreements can be really helpful, but really bad agreements can be harmful. So we list some of the harms there. But they can be really great if they're done well. But they can also have some unintended consequences. So, for example, giving an entity that's abroad too much authority can create a permanent establishment for the entity that's here. We have to consider local law in the other jurisdiction so that it's not violated. Intangible property should be sufficiently identified. The intercompany agreement terms, once they're in place, you better follow them. Just like any sort of transfer pricing policy you might have. So Same with intercompany agreements. They should be followed, and if they're not, that's going to be a problem.
For example, I had a company. Go ahead. Sorry, Michael.
Correct.
Right, it has to.
Exactly. Absolutely. Thank you.
Yeah,
Yep.
definitely.
Exactly.
And this is an example of I think a little bit of that, as well as not following an intercompany agreement, because this company had a 10-year technology license agreement between the U.S. and its UK entity, and it was licensing out IP in the form of technology and know-how. They had a 5% royalty on that. So actually, I'm sorry, it's reversed. It was the UK entity charging the US entity for technology. So a company said, you know what? At year 7, they said they looked at the technology and said it's obsolete. You know, we're just going to shut off this royalty. But they didn't terminate their agreement, and it was a 10-year agreement. So HMRC, Her Majesty's Royal, I forget what it stands for, Royal whatever. HMRC.
Revenue and Customs.
Okay, good.
Yeah.
Yeah, Revenue and Customs came in and said, oh, you've got a 10-year agreement here, pay up. And it was a lot of money. It was a couple $100 million pounds I'm sorry, not 10, like over 10 million pounds of tax that they had to pay. So it was very expensive. And there was not much the company could do. And that was double taxation, because now you have to go to the US side and say, well, this technology is not really valuable, but we had to pay for it. Can we get relief on the US side? That's a hard story to sell to the IRS. So let's go into a case study. This was a relatively small company, $60 million company. That's, we'll call it Fabric Co. here. It's in the textile industry, pretty straightforward industry. They're very entrepreneurial, so they're looking at trying to optimize the business. You know, sometimes things like transfer pricing aren't on the front end of what they're thinking about, so they evolved over time. They were audited in 2010 and 2011. And there were no transfer pricing issues raised during those audits. And so as a result of those audits, this is an important point, the result of those audits, some companies said, oh, we don't really need to worry about transfer pricing. The IRS has even asked, you know, they thought it was fine. So they didn't do much with transfer pricing. They basically let it go. And so that brings us to additional facts here, where the company is actually manufacturing and sourcing product out of Asia and bringing it into the U.S. And the functions in Asia are around procurement, mostly procurement. It's not in the sense they're manufacturing in the sense that they're outsourcing to other parties, other third parties. But the U.S. was the headquarters company, and there was a lot of decision making in the U.S. as well. And the company also sold to Canada and Mexico at cost plus 20% to third parties. So then the IRS came in, and they didn't bless their transfer pricing. They looked at their transfer pricing in 2012, and they said that there should have been some royalties that were paid from China to the U.S. for the use of the technology. And in addition, there's a significant amount of services that are being provided from the U.S. entity to the Chinese entity. And this is a $60 million company. $2 million of income is due now into the U.S. That's just in 2012. They drove the U.S. entity into a loss. The Chinese entity into a loss through this adjustment. So basically taking a formerly profitable Chinese entity and making them loss-making. The IRS said they didn't have documentation in place, so clean slate. They went crazy. They went way overboard. I mean, to drive an entity to a loss is going too far. But I mean, they just went gangbusters, and I think they're pretty gung ho because they're tired of going against large multinationals that have everything. They're more their ducks in the row. So they're looking at a small company saying, "Oh, we have an opportunity here to bring some income into the U.S." So, and then also there were also open years. So an adjustment in 2012 would go forward into 13 and 14. So there's a lot at stake here for this company. I mean, I'm not saying bankrupt them, but it was going to hurt them significantly. So this is a summary of the proposed adjustments. You can see here that the IP charge was about another $550,000, services of $1.4 million. This is the company's. A lot of it's the company's CEO going into China and providing advice, providing services in China. the way the IRS imputed this was a percentage of revenue. So it was, in effect, not only was there a royalty on IP, there was a royalty for services on top of it. They just went nuts. And so there's a 35% tax on that. Plus, the IRS said, you guys are subject to penalties. So in the NOPA, they didn't put penalties in, but they said, well, we can, if you don't pay up, we will charge penalties as well. So they have about $1 million of exposure here just in 2012. So again, it's usually transfer pricing dispute is multiple years are involved. So there's a lot of money at stake. So we refused the facts, and we developed a position saying, this technology isn't really special. And in fact, one could argue that the technology is being developed in China with the third parties. The third-party mills actually were providing a lot of the inputs on the design of the fabrics. So we believe that the royalty is not supportable. So that's the look at royalties. Then we also looked at the management services. And here we argued that, the comparable profits method is the appropriate method, but you don't take a percentage of revenue to apply to that. It should be a markup on costs, which is a huge difference. And so, and so we calculated what should be. We came up with an alternative number, which was quite a bit smaller. Obviously, we'll talk about that in a minute. And so, and we also looked at the comparables, and their comparables weren't appropriate. So we developed a new comparable set for them. And then the tangible goods sales. Here's where the set-off comes in. The U.S. was, China was selling to the U.S. at 4% markup, which is pretty low. So the risk there, as I say, IRS on this transaction, they're at risk in China for having a low markup. So we need a set-off there, and so we developed an analysis to justify a set-off. So taking a step back from all of this and looking at this strategically from a negotiation, a dispute resolution, a friend of mine talked about looking at a zone of potential possible agreement, ZOPA. So it's an acronym that was new to me about a couple years ago. But the idea is what we're trying to do to resolve this is try to develop a zone of where potential agreement could be between the taxpayer and the tax authority. And so, of course, at the lower end, the company's range goes from zero, no tax, or perhaps even a refund, to the other end of the range was, okay, we'll pay some tax, but it'll be at a level that's lower cost than having to go to court and litigating this. So that's the company's range. On the tax authority range, of course, they throw in their highball adjustment, which is at the right end. And then their lowest point, which is where they feel like they'll cringe, but they'll settle for, again, dispute costs, court costs, litigation costs, and all that. So there's all kinds of factors to think about. There's additional costs and time in terms of looking at this, the hazards of litigation, precedents, future compliance, and emotional factors. That's actually one of the biggest ones. When we met with the IRS, the agent started screaming at us because he didn't like our arguments, and I was amazed. I was like, why is this guy screaming at?
They take it personally because they work really hard on this, and they're like,
right.
I put it on paper.
Yeah,
it's
yeah.
personal
So
now.
their reputation within the IRS is at stake. Mm-hmm. So we're attacking their analysis and their conclusions. So anyway, here's where we came out. So instead of 1.9 million, we brought the management services charge down to 450,000 instead of 1.4 million. Using a markup on cost approach. So a big difference there. And then the set-off is that 250,000. So instead of 1.9 million of total adjustments, we proposed 200, and at the end of the day, we negotiated 250 was the negotiation at the end. So it was a huge win for the client. It was 13% of the original assessment. This played out well, but you could see kind of where it might have gone like completely wrong for the client. So we were thankful to come up with a good result for our client. So some of the key takeaways is the IRS, and actually during this meeting they said, we're going to make you very happy. We're going after small companies. So I don't know if that makes me happy, but I mean, there's a concerted effort to go after smaller, less prepared companies. So I mean, be aware. Just because a company is audited, I hear this even from larger companies. We've been audited. They don't even ask for our documentation. That doesn't mean anything. A new audit means a new slate, new team potentially, new requests. fresh pair of eyes, so you're still at risk. And it's like playing Russian roulette if you're not prepared. Audits resulting in adjustments to taxable income typically involve multiple years. So we're not just looking at a single year. Oftentimes we're looking at multiple years, and those costs can add up like crazy. And then, of course, you have two sides to the equation. So let's say you come up with an adjustment, the settlement in the U.S. In our case, we couldn't go back to China. It was too old. China wouldn't have accepted it. So there was some double taxation there. So it's better to be prepared with support. So the analogy that a partner of mine used is when you have transfer pricing documentation in place, there's no guarantee that even with an APA, there's no guarantee of a good result, but you're boxing from your front foot instead of your back foot. So if you have transfer pricing documentation in place, it's like sending a signal saying we've thought about it, here's what it is, and now they have another hurdle to go over in terms of attacking your transfer pricing. So here's another case study involving the CRA, which stands for Canadian Revenue Authority. So this one is a company, a larger company. This one was a $2 billion publicly traded company. And they made an acquisition in Canada. And as I mentioned earlier, under the U.S. regulations, it's not an option. The companies are required to charge services that they provide to other countries. So, and that's what this company did. They charged out the value of the services. They did not prepare documentation, though, a full report or anything around it. They just did everything on spreadsheets. And so they charged Canco $800,000 in 2010. And again, no transfer pricing documentation was prepared to the extent that is formal documentation. So the risks were on two sides. The IRS side is, did you charge enough? On the Canadian side, did you charge too much? Well, they were audited in Canada, and the Canadian revenue agent said, we're not going to accept these deductions. Denied deductions of $800,000. So here we go. Here's a company now facing $800,000 in double taxation risk. And basically the CRA said this was an acquisition. It was a standalone company at one time. They're self-sustaining, so they don't need these services from the U.S. That was their argument. So working with the company, we explain what happened factually. So, and actually, before we got involved, the company was going down the road of, you don't understand the arm's length standard, and so they were trying to came up with this more teaching them. They felt like they needed to teach them transfer pricing because this agent wasn't that familiar with transfer pricing. Actually, he was kind of dabbling in it, and he wasn't getting his experts involved. So we advised the company, no, just be factual. Present the facts. And the facts were that they acquired this company, but people left, and over time they needed more support from the U.S. And we looked at specific functions, and then we came up with more of an explanation. Okay, here's what we did in Treasury and tax to provide value to the Canadian entity. That's the key, is it needs to provide value. IT, information technology was provided, IT services were provided, risk management services, HR services, and the Canadian company benefited from these services. So, and also our rules, the U.S. rules require us to charge these out. So you can often use that as leverage too. We don't have a choice. We have to charge these out. So at the end of the day, it's because CRA can be pretty tough. And go ahead, sorry. Yes.
Yep, I think that's kind of a quintessential example
Right,
of one where you think, why would I need to have a price for that? Yeah, Bev.
I guess add to that though, I'm not sure that there are some services that you can. So while that would be a
Right.
Yeah.
It might be whatever you determine. I don't know the distinction.
Yeah, actually, this is a good segue to this slide here, because this is how we look at costs. Go ahead, Michael. Correct.
And a good way, if there was
Right.
service,
Yep, those are. Yeah, I agree. Yeah, that's very good. Yeah, and a lot of the services, the way this is a kind of a simple framework here that's on the slide that talks about what types of services to charge out, and at the top there is stewardship / duplicative services. Those are non-allocable. So those services are associated with shareholder type related activities. Preparing the 10K. Not chargeable. Stuff that's geared towards servicing the shareholders. And then you have routine / administrative type services, and that's where I think you were thinking of in terms of the regulations. And in the U.S. regulations, the thick regulations that are out, they do talk about, it's called the services cost method, and you have to qualify for it. There's a bunch of hurdles to go over, but you can, to the extent that it qualifies, you can charge those out just at cost. And then there are activities linked to, I call them critical success factors. And those are services that don't qualify for the SCM, and so you're required to add some kind of markup associated with it based on the arm's length standard. So you come up with an arm's length markup, and what we do for that is we'll try to identify comparable companies that perform similar types of services, so like HR services, and we'll come up with a range of what those companies make in terms of a markup, and we'll apply that markup on the costs that are being charged. Then the last one is critical, and those are intangible development activities. So activities that actually generate intangibles. Think about R&D. Think about marketing, branding, things that create an value in the company beyond a kind of a routine situation. That's very important to think through, as I mentioned before, in terms of whichever entity you want to own that IP should pay for it. So if you want it to be owned in the U.S., don't charge those out. Keep them in-house. So, and like Michael was saying, it's good to take a step back, and part of the explanation to justify. So you have the service provider and you have the service recipient. From the service recipient perspective, you need to explain that these services create value, in the sense that the service recipient would have had to hire somebody else to provide those services, or would have made less money if not for these services. So these are different things to think through. And if something is actually contributing to the technology or is related to know-how, special know-how, that could follow. It could be a really important actually service that would justify something more. The other thing to look at though too is are these charges going to drive the entity into a loss? I always like to look at things from a profit split perspective as well. So. In terms of making sense of all these charges, don't put them in willy-nilly. Look at the big picture too, and what the impact is on profitability across the supply chain. So in this case, we identified the time spent by the company and did an allocation based on time spent. So we identified the people that provided the services, and then identified the costs associated with those people. And then we developed arm's length markups based on comparables, companies that provide comparable services. And I just showed this table because this is kind of a typical output from an economics report. This table shows that for these services, we had a range of 3.4% to 11.6%. So the conclusion of our report was a markup anywhere in that range is considered arm's length. So the CRA begrudgingly said, all right, I'll accept them. It wasn't, obviously it wasn't cheering or whatever, but we were able to put together a compelling case for them to accept it. But again, it's not guaranteed. It could still be, a negotiated about. He might have just said, I'll just accept half of it or something like that. So in this case, we were able to get all of it. And but now the company is more careful, and they have comprehensive documentation. So they're in pretty good shape now.
All right, so now we're getting to the summary and key takeaway portion of the presentation. So first we'll start with the pre-audit planning strategies. So we've obviously talked to death some of these issues, have documentation, consider intercompany agreements. I think one we haven't talked about is as you're doing initial planning of a related party transaction, which is really the best time to approach this issue because you have beneficial allocations that you can make at that time. And think about, are there other relevant transactions? Look at profitability targets, consider alternative structures. So really think about the transfer pricing when these transactions are starting to be formed. I think we've already talked about this slide, so I'll skip it. Have documentation, otherwise there might be penalties.
Got it?
All right, this slide I really like because I think this should be sort of kind of an internal audit that a taxpayer should do fairly regularly to consider what kinds of strengths and weaknesses your transfer pricing positions have. So going back to the audit roadmap and the Internal Revenue Manual, if you go through the same steps as the IRS would go through, look through your returns, look at your transfer pricing policies, calculate those same financial ratios, look at industry standards, consult experts, basically conduct your own internal audit if you can, then you'll have a pretty good idea of what your transfer pricing exposure might be, where you can improve, and when and if that IRS audit comes, you can be ready. So my big caution here is if there's any anticipation as you commence down this road that there might be substantial adjustments, that you'll conclude that there were real issues that need to be fixed, make sure you either have in-house counsel or outside counsel involved to see if you can get at least some privilege on that analysis so you don't have to later turn over to the IRS like, hey guys, look at what we did and we figured out that we should owe a lot of money, but we fixed it, don't worry. So I think an internal audit is a really good planning strategy to do. Yes. Very good point. Okay, so once you kind of figure this out, think about what the strategy will be when that initial IDR is received. If you wait to develop your audit strategy when that initial IDR is received, it's way too late because you've only got 30 days to respond. So it should be ready. If I get this IDR, what's going to be my plan? So there's, kind of the three options. We know a couple of them aren't very good ones, but obviously you can think about, well, I don't think I have any risk on my transfer pricing, so I don't need any documentation. You can have good documentation or you can try for the APA, but we've talked about the pitfalls of doing that. On the documentation, so if you get that IDR and the documentation is lacking, you didn't have that contemporaneous study. So what I would recommend and what we do is you try to look at what documents existed contemporaneously that you can provide to see if you can satisfy those principal document requirements. So provide as much contemporaneous support for the transfer price as possible. So respond with that timely, and if you can, legitimately take the position that that satisfies the principal document standard, take that position. And then supplement that with an analysis, with a study that someone like Guy or an economist would prepare that would support your transfer price. So one thing that I saw in a recent audit, not working with Guy, but it was with a different economist that had already been on the case, is they prepared the supplemental study, but it was prepared as if it were contemporaneous, which is really bad. So it's good that it was.
That's right.
You were like, oh
I wouldn't
God.
do that.
He would never do that. Yeah, so I mean, the whole entire study was prepared like this is a contemporaneous study, and here are all the problems if you don't have a contemporaneous study, and if you don't provide documentation, here are all the penalties. So like the first 30 pages of this report was really bad, basically. So I think really important, like if you're preparing a supplemental analysis and providing that to the IRS, it should be very clear that it was not contemporaneous, but that also it in no way undermines your position that what you did provide was contemporaneous and sufficient. So it sort of has to be very clearly provided as like, this is just helpful to the contemporaneous documentation that we did provide.
That's right.
So kind of green, yellow, red strategy breakdown. So you have good documentation and defensible transfer pricing. You're in a great position. So what you want to do is kind of nip that examination in the bud, right? So you want to provide it. You want to show like, hey, we did this really well. We have great documentation. Our method is great. No problem. Get this audit concluded as quickly as possible. Move on. If you have poor documentation but pretty good transfer pricing, we sort of talked on the last slide on how to approach that. And then if you have both poor documentation and problematic transfer pricing, you're in a pretty bad situation. So if you did do an internal audit, there's some strategies on how to kind of mitigate the effects of if an audit were to commence. One option to always consider is amending your returns, fixing it up before the IRS fines you. If you choose not to do that and an audit does commence, just be prepared for a long battle, an expensive battle, and it's likely to go to appeals or to pay. We talked about all of this.
So just in summary here, in terms of what we talked about, focusing on the facts, I think of transfer pricing as I don't know if anybody's familiar with the Minto pyramid, but it's a logic tree. And the top of the tree is our transactions are arm's length, and just putting out all the facts that support that conclusion that the transactions are arm's length. So you have intercompany agreements, you have a functional analysis that talks about the functions and the risks and the assets in the company and who does what. Then we look at comparables data and compare how the company's pricing their transactions against external comparables. And then a financial analysis that concludes, the objective would be to show, here's how the company's transfer pricing set up, and here are the results of the pricing, and then here are the comparables. And based on these transfer pricing methods, the transactions are arm's length. That's the idea. It also makes sense in terms of going forward. So a lot of transfer pricing practitioners might just deal with what's out in front of them, but I also think it's important to think about going forward in terms of what's going to happen in the future with the company, and how is the company expecting profits to do flow in various jurisdictions. So I also look at profit splits. Does the profit split make sense? You might not use there is a profit split method, and it's actually being used more and more now with BEPS, and looking at the holistic organization and how profits are split in the value chain. But even if it's not being used, I like it to look at profit splits and see, does this make sense? Does it make sense for this entity to get 70% of the profit and this entity to make 30% if there's only two entities involved? Well, it does, because this entity owns the IP and has a lot of risk and manages most of the risk. So it does. And maybe there might be other cases when it doesn't. So take a big picture look at it. Follow a disciplined process. So the IRS audit guide that Masha talked about is important. Develop a negotiation strategy and try to understand the tax authority position. And part of that is going to be somebody who's staked a position internally within the IRS. So they're going to be tough on their position, and they might even yell at you. So be ready for that. Even if they yell at you, be clear, be professional, be courteous, be kind. There's more to be gained by being professional than to scream back at them. So avoid that temptation. With this smaller case study, the owner insisted on being part of the discussions, and we were cringing because the attorneys and us, this is on the West Coast, so Masha wasn't involved in this one, but this is an LA law firm, and we really tried our hardest to convince the owner, you shouldn't be part of these meetings because the IRS can try to negotiate directly with you, and there's a whole host of reasons for you not to be there. You could disclose things that you might think they're good arguments, but they really aren't legally. But he insisted, so of course he's paying the bills, so he was in the meetings. But he, I could see him wanting to come out of his chair and yelling at the IRS agent, in return. But anyway, he was good. He kind of stayed in the background and then provided us with his take on it at the end of the meeting. So it was good to have him there, but it was definitely a risk. So I think we talked about some of this. So audits, just because you audited 1 year, you might have an adjustment. Multiple years of audits of open years creates multiple years of potential adjustments, and we always like to get, especially on issues where there's a lot at stake, we like to get local input from local countries. So if it's a issue involving the U.S. and China, we do have global capabilities where we have alliance members in various countries like China. And it's good to get their take on it and build their take into the documentation to tell the story from both sides, in this case, the US and China, so that we can anticipate those issues and address them as much as we can in the documentation. So key questions to, you want?
You want to go
Yep.
with this one? Yep.
Yep. So these are some of the questions we like to ask from a strategic perspective. How will the business evolve over the next 5 to 10 years? Where are the company's current and future intangibles? Is the business becoming more global? Some businesses are, especially in this environment, they might become less global. So whichever direction the company's going in, we need to think about that. If it's becoming less global and they're moving assets from, say, Mexico to the US, there's some exit charges that could potentially apply, or some other things that could apply. So, think about all that, the implications of all that. Is the company centralizing or decentralizing in various jurisdictions? And where's the company going to be profitable, and where might it not make profits? So just thinking in terms of the ongoing, it's not just a static issue. It's a very dynamic issue to look at. And with that, that's our contact information. Feel free to contact us, and we've left a few minutes here for Q&A, so we'd enjoy having any discussions that you guys want to engage in here. Comments? Well, the way that's defined in 482 is as if the IRS has a pretty low, it's not so much ownership or percentages, it's is the company not reporting taxable income appropriately. So does the joint venture have an ability and a motivation to shift profits outside the US to Singapore or Switzerland through this joint venture? Other countries are the same way. When I was in Europe, that was a huge issue. So it wasn't just intercompany transactions. Joint ventures statutorily fell into theirs. Actually, their laws would refer to joint ventures. We don't, that regulation I showed you, that doesn't explicitly refer to joint ventures, but you can see where they would come in. I do, yeah. There's a specialist here in the Twin Cities that I've worked with, or in other areas. So I don't do customs, but I work with others that do. And there's a lot of times when they need to be dealt with at the same time. So that's a good point. So we didn't talk about customs, but transfer pricing impacts duties as well. And there's a dutiable value that may or may not be the same as the transfer pricing for tax purposes. So we do get into. Again, I'm not a customs specialist, but I will work with a customs specialist to try to rationalize all that.
Yeah.
Yeah, so you can do an adjustment. The intercompany agreement would more likely have to do with going forward. You could try to address the past in the intercompany agreement. Maybe that's a separate agreement. Maybe that's where Masha would come in terms of how to structure the intercompany agreements. When I'm working with intercompany agreements and I'm looking at them, usually it's ongoing operations as opposed to justifying a certain adjustment.
I mean, I think the two key choices for going back is, one, do I go back and amend my tax returns and support that? And then that way you're avoiding at least the penalties, but you're paying the tax up front, so you're essentially self-assessing. Or two, do I just get my ducks in a row and be ready in the event I'm audited, and then just do it correctly going forward? So then put that intercompany agreement in place, put a transfer policy in place going forward so that it's right, and then just be ready to fight the battle if it comes up for the past.
You might be able to justify the past. In fact, there's some special provisions, like in 42, where if you're entering a new market, for example, there's specific things that say, you know what, if you're entering a new market, it makes sense to have losses for a couple of years. So there might be some flexibility in terms of looking at it from that perspective, and also looking at it from a multiple year perspective. So for U.S. transfer pricing, it's usually a multiple year. We're usually averaging multiple years together. So maybe you got it wrong in the past, but we make it up in the future. That could show goodwill. It's not slam dunk, I mean, but it's a way to address it. Say, you know what, yeah, we underpaid in the past, but now we're looking at this from a multiple year perspective, and here's what it comes up with a 3-year or a 5-year average.
And then the advanced pricing agreements, maybe you were thinking of those, and that's when you negotiate with the IRS. So we kind of poo-pooed those a little bit. But if Judge Kerrigan overrules Judge Kropa, I mean, maybe those will, we will like those again, and then maybe that might be the way to go.
Yeah, they made a comeback in India. India used to be really painful to get an APA, and India made a concerted effort to streamline the process. So now it's like, okay, maybe we'll get an APA in India. Yeah. Wishful thinking. No, you're good. We'll move on. Yeah.
That's when they don't open the examination.
Right.
Do you want to do that?
Yeah, so a set-off would be, like, for example, in that case study where the IRS had, $2 million of adjustment. The set-off is, we have a different transaction that would require an adjustment going the other way. So one offsets the other.
I think it's a little different. So instead of think of it this way, so if you're selling, from company A to company B, and the IRS says, oh, that price needs to be adjusted favorable to the IRS, well, then we also had transactions going from company B to company A, which should be adjusted in our favor. Right. So, okay, IRS, you have adjustment in your favor, but look at our adjustment. These really offset each other because nothing was really arm's length. Yeah.
So when we argued this, the IRS didn't jump out of their chair and say, good idea. Their reaction was, new facts. It's pretty nasty. It's like
but you've got those 30 days if they issue, your adjustment.
Right.
So,
right.
Hey, too bad.
They were not happy with us.
No.
They were not fans of us. Right.
Yeah, it's great.
We need to show that both transactions are arm's length. So the purchase needs to be arm's length, and the sale also needs to be arm's length. So
it would likely be separate analysis of each.
Right. That's a good question.
Yeah, so, if you're the one who's going to get audited and not them, then they're going to request that documentation from you. And so you're going to have 30 days to provide it. So I think, yeah, but it might be good for you to know in advance what it is to make sure that it complies with U.S. standards.
Is your parent in Japan? Germany?
That's right, exactly, and that you're operating in compliance with your own policy. And then if the IRS, if the parent doesn't want to produce it, then that's where those FDRs come in. So instead of that initial information document request, that's when they issue the formal document request, and that can really be a problem. So, yeah.
Well, we have a reception here, so thank you very much for joining us here.
Yeah.
We'll be happy to talk more about the reception.
Thank you.